Required minimum distributions. What the IRS requires you to take. The IRS has a message for everyone with tax-advantaged retirement accounts. You can't keep your money there forever. At some point, you have to start taking money out. And if you don't, the penalties are brutal. We're talking 25% or even 50% of what you should have withdrawn. Here's what you need to know about required minimum distributions. Required minimum distributions, often called RMDs, are the IRS's way of making sure you eventually pay taxes on the money you've been putting off paying taxes on. If you have traditional retirement accounts like traditional IRAs or 401k accounts, the government wants its share eventually. Here's how it works and what you need to know so you don't get hit with penalties. For most of modern history, RMDs started at age 70 and a half, but the setting every community. Up for Retirement Enhancement, also called the Secure Act, changed this. Now, RMDs start at age 73 for anyone born in 1951 or later. So if you were born in 1952 or later, your RMDs start at 73. If you were born in 1951 or earlier, check the old rules, but you might have already started taking RMDs at 70 and a half. The good news is, that gives you a few more years of tax-deferred growth. The bad news is that once they start, they're mandatory. The IRS uses a formula based on your account balance and your life expectancy to calculate your RMD each year. The calculation divides your account balance by your life expectancy factor from their tables. Here's the key point. Your RMD is based on the previous year's account balance. So on December 31st of each year, you need to know what your accounts are worth to calculate the next year's RMD. For example, if you're 73 and your account has $500,000 on December 31st, your RMD for the following year would be roughly $18,800. That's dividing 500,000 by 26.5, which is the life expectancy factor for a 73-year-old. That's the minimum you must take. You can take more if you want, but taking less triggers penalties. Traditional 401k accounts from old employers, traditional IRAs, and similar tax-deferred retirement accounts all require RMDs. If you've rolled old 401k accounts into an individual retirement account, that's still a traditional IRA and still requires RMDs. One common mistake is forgetting about old 401k accounts from previous employers. If you've changed jobs multiple times, you might have several old accounts scattered around. These all need RMDs, and it's easy to lose track of them. This is where it gets painful. If you don't take your RMD on time, the IRS charges a penalty of 25% of the amount you should have withdrawn. In some cases, the penalty can be 50% if the failure isn't corrected quickly. Let me make this concrete. If you should have taken a $20,000 RMD and didn't take anything, the penalty would be $5,000. That's significant, and it's on top of the taxes you'd normally owe on the withdrawal. But here's what many people don't know. If you miss an RMD, you might still be able to correct it. The IRS sometimes waives the penalty if you can show reasonable error and take corrective action, like taking both the missed RMD and the current year's RMD in the same year. The best approach is to mark your calendar, set up reminders, and never miss an RMD in the first place. All of these account types require RMDs. Traditional 401k accounts, traditional IRAs, SEP IRAs, and similar tax-deferred retirement accounts. Roth accounts are different. Roth IRA don't require RMDs during your lifetime, so you can let the money grow tax-free as long as you want. This is one of the reasons that Roth conversions can be so powerful. You pay taxes now to get tax-free growth forever. If you have a Roth 401k from an employer, that's different. That still requires RMDs. But personal Roth IRA are fine. The year your RMD starts can be a tax planning opportunity. Taking a larger withdrawal in your first year could push you into a higher tax bracket, so some people consider whether to accelerate withdrawals before RMDs start. This is sometimes called a Roth conversion. You take money out of a traditional account, pay taxes on it, and put it into a Roth. The benefit is that future growth in the Roth is tax-free, and you won't have to take RMDs on that money. Another strategy is qualified charitable distributions. If you're 70 and a half or older, you can give up to $100,000 directly to charity from your IRA each year. This counts toward your RMD but isn't included in your taxable income. It's a way to satisfy your RMD requirement while supporting causes you care about. RMDs are one of those things that's easy to ignore until they become urgent. The rules are complex, the calculations can be tricky, and the penalties are severe. A financial advisor can help you calculate your RMDs, develop a withdrawal strategy that minimizes taxes, and avoid costly mistakes. This is especially important if you have multiple retirement accounts, complex family situations, or significant assets. The cost of professional guidance is often far less than the cost of mistakes. RMDs are one of those financial realities that can't be avoided. The best approach is to mark your calendar, set up reminders, and plan ahead. Understanding the rules now will save you money and stress later. Don't let the IRS surprise you. Start thinking about RMDs years before they start so you can develop a strategy that works for your specific situation. If this was helpful, hit that like button and drop a comment below. What's your biggest question about retirement distributions? I'd love to hear what's on your mind. And if you want more content like this, subscribe. I share exactly what I wish I knew, so you can make smarter money moves.